You're listening to The Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday, March 3rd show, bringing in expert advice and inside knowledge on today's events in our local economy and how it can affect your money. If you're hearing my show at a different time of day, you are listening to a rebroadcast, but I'm here to answer any questions or connect you with the guests that I have on the show today. Call the show at 1-855-400-1150. Again, that's 1-855-400-1150. Or online at themoneyhour.com. In studio right now, another regular contributor to the show, Gary Cassill with Mountaintop Advisors, LLC. And we're talking about real estate and your IRA. Gary, thank you so much for coming back in studio.
Hey, thank you very much for having me, Tina. I appreciate it.
And a little bit about Gary, first licensed in 1984. Gary has been a high-volume bank program and at a very well-known credit union. He has a Series 663 and Series 7 license, in addition to being fully licensed for life insurance and annuities, both fixed and variable. So interesting topic that we're talking about, Gary, is the real estate and in your IRA. So with interest rates so low, how can an investor find ways to get get a decent income from their investment? CDs are not very well right now, doing so swell.
Yes, you can say horrible.
Terrible.
Yeah, so there's just it's very difficult with fixed types of investments like annuities and CDs to get any sort of decent return. So, like your customers know, your listeners, it's a great time to borrow money. It's
Yes.
a cheap time to borrow money. But it's a pretty rough time to try to get any sort of income off your investments if you're looking for safe investments. So let's start with the basics. When you've got an investment account, the traditional investments that people use are stocks and bonds and cash. Those are the three things. The first one is stocks. And as everybody has noticed, they are quite volatile.
Yes.
They have done very well for the last 10 years, but they're very, very volatile. And every decade, they've been getting more and more volatile. And there's a couple of reasons for that. The stock market's now kind of dominated by these electronic, algorithm-driven institutional investors like big pension funds, mutual fund companies, and hedge funds. That sort of destabilizes on a day-to-day basis what goes on.
Yes.
Used to be, back in our parents' time, they would buy stock, they'd hang on to it for a long time because it cost them a lot of money to change hands, to sell and buy. So they tended to buy and hold. With these people doing this, that gets thrown out the window and everything gets more volatile. And volatility means risk. Bonds are the second thing. And surprisingly, I think this is one of the more scary places to put money right now.
Okay, why?
Well, you don't get very much return from putting money in there.
Yeah.
But the second thing is we're sitting at all-time interest rate lows.
Yes.
When interest rates go up, bond
Which they already have.
Yes, bond values go down. And they go down quite a bit. They'll go down multiples. A great example of this was in 2014 between May and August. That's only 3 months. Interest rates went up less than 0.5%. The Fed tried raising interest rates at that time. And the safest investments in the world, which are U.S. government securities, the long-term ones, went down 14.3%.
Crazy.
So if you were only earning 2% on those investments, you just lost 7 years of earnings in a 3-month period of time. It's going to happen. It's math. It's kind of like the teeter-totter that you played on as a kid. You know, one side goes up, the other side has to go down.
Sure.
So when interest rates are the side that goes up, bond values go down. It's very, very simple, except unlike on the playground, the fulcrum point is not in the middle where it's fair. It's way over to one side. So if interest rates go up just a little bit, the other side goes down a lot.
Yeah. So let's talk about some other options here. Let's talk about investing in commercial real estate with your account. If you don't have millions of dollars. So what are the options there?
Well, and oddly enough, most of my clients don't have millions of dollars to just throw into a commercial building.
Okay.
But there are ways to do that the average person, the people that are listening to the show, Tina, can do. And that is real estate investment trusts is one way. Business development corporations or BDCs, that's another way. And what those things do is they pool a bunch of investors together kind of like a mutual fund would, and then some experts that are managing the fund will go out and find the right buildings to buy in the right areas, in the right types of buildings. And if they're good, they typically will spin off the income that comes off of those buildings from the leases. And typically the investor will get maybe 5, 6, 7% paid out every year, which is much better than bonds, much better than CDs.
Yeah.
And if they remain patient at the very end, if the people doing the right job bought the right buildings and they did things to improve the values, then they'll be able to sell them at a higher premium. So the client, the investor, will get back more than they put in.
Yes, and the benefit of getting into commercial real estate is it's just there's a lot more to work with there. And you said the key thing. I mean, they really have to make sure that they're working with a company that really understands the buildings, and the companies that they're investing in are going to be a good investment. Right.
So they're going to try to buy buildings that are in sort of the path of progress, and where the economy is doing well, where the rules are favorable to the landlord, that sort of thing.
Makes sense.
Yep.
So what about qualification for investors that want to get into this type of investment? How does that look?
Sometimes the minimums can be kind of high.
Okay.
And sometimes the investor themselves has to be qualified. They have to have maybe a minimum net worth of $1 million, and maybe in that investment they can't put anything less than $50,000.
Okay.
But also there are some other types of investments in the same sort of programs where the minimums are much more reasonable, $2,000 minimum, and maybe no net worth or a very small net worth requirement. So are you helping your clients, Gary, in navigating through this process and helping them pick the right opportunities for their portfolio and what their abilities are? No, they're all on their own.
Got it.
No, of course, yes.
You do.
Yes, of course I help out. In fact, that's one of the challenges with this. A lot of people don't know about this type of investment at all.
I was going to ask how long it's been around.
These types of REITs have been around for over 35 years. And what people don't know, it's sort of some sort of a secret, evidently. If you take a look at the Real Estate Investment Trust Index. So all the good, bad, and the ugly real estate investment trusts that have been out there, and then versus the stock market. The S&P 500 is the best known index. That's good, bad, and indifferent types of stocks.
Okay.
There's just 500 of them. If you take a look at those, the REIT index has done better in the short term and in the middle term and even in the long term than the stock market. So I guess the big question is, why is it such a secret?
Yeah.
But in any event, I'm letting the cat out of the bag.
Yeah,
so.
Well, I know you specialize in this, and that's why I really wanted to bring you in studio to talk about this conversation, or have this conversation and share it with my listeners. So they're investing in the actual buildings, correct?
Well, yes and no.
Or in the lending and money.
They can do either one, Tina.
Okay.
For over 35 years, the timing looks pretty good right now. There was I don't know if I can say this about the freewheeling lending practices that happened a while ago, but now lenders are very restricted on what they can do with real estate. So for commercial loaning, they used to be able to loan up to 90%.
Okay.
And now, because of Dodd-Frank and some other restrictions, maybe it's only 50 to 60% on commercial buildings.
Okay.
So if the typical buyer only wants to put in 10% of his own money to buy that investment, then he's going to have to go somewhere else to find that middle part, that mezzanine loan, that middle loan. And that's sort of like a second mortgage on a house. The interest rate's a little bit higher on that. And but if you're the one that's lending the money into that second area, the rates can be pretty attractive as a lender. So some investors can end up doing the lending portion of it. You can buy into that.
Okay. So Gary, REITs own the building and collect the rent. So how do you know that this money's getting distributed the way it's supposed to?
In a real estate investment trust, they're required by law to return at least 90% of all of their income from the building back to the investors.
Okay.
If they don't do that, they lose their tax preferred status, which will kill them. It's crisis mode if that happens. They make sure they do that because they don't want to lose their REIT status.
Yeah. So what about the REIT's manager's previous track record? Is there a way to look and see what they've done before and to make a decision if that's one that you want to invest in? Right.
So how do we look under the hood? How do we figure out if they're any good or not?
Yep.
What's interesting is in that big, thick, ugly, scary prospectus that you're always supposed to read, they're required to put in what their results have been on any previous REITs that they've offered.
Okay.
They have to.
Okay.
So if you take a look in there, you can take a look and see how they've done on every one of their buildings. And I've looked in there, and they have to admit when, we did one and it didn't work out that well, but we did 3 that did.
Sure. And I would imagine that, obviously, they're not going to be able to pick the best all the time. There's going to be, you have just like any other investment, you're going to have ones that do well and ones not that do well. But you look at the overall performance and be able to see if that's, and also I would imagine with this information could be very powerful because you can do a comparison to see what is good in the industry as far as making those good decisions, right?
Correct.
Yeah.
But in more than that, though, you want to make sure that the people that are that you're possibly going to invest in are in an area that is growing and has a good supply and demand drivers.
Got it. So, Gary, I would imagine that you're going to pay higher prices on that investment for companies that are performing better, or if they're buying into better product buildings. It's going to be a more expensive investment, correct?
Not necessarily. I think what you might find with there are different types. So some of the REITs or BDCs are more aggressive, and they might take more risks but have a higher potential for gain. And then others are going to be very, very conservative. The buildings that you're buying may have close to 100% occupancy with long-term leases and very, very credit-worthy tenants. So the more cautious investor might feel a lot more comfortable in that.
Got it.
The other type, the more aggressive ones, they might be buying buildings that are just about to be foreclosed. And the tenants in there are not paying enough for that person to pay their bank note. And so things are kind of going south. And somebody's going to have to come in there, do some quick cleanup, and immediately have a good team that can put a bunch of new tenants in there very quickly.
So it's like a flip.
It's like a flip.
Yeah, a flip in the commercial arena.
Exactly.
Got it.
If they're good.
Yeah, it can be very profitable. And the timing, it's just like a flip in residential real estate. It's a lot with timing as well. We've got just a couple minutes here, but I wanted to ask you, would you consider this a safe or risky bet? Because like any other investment, or I should say investment, not bad, any other investment, the more return usually has some more risk to it, and the less return, typically less risk. So what would you say about REITs?
I've had a couple of clients come to me and I start talking like, well, in this one, we're going to get a 6% rate of return until, they sell the buildings. And they think, wait a minute, I'm only getting 1% in my CDs. This has got to be 6 times riskier. And that's very difficult to quantify, but this is not a new category. It's not a new thing, and it can be a medium risk or a low risk type of an investment. The one thing, though, that people really need to understand about these real estate investment trusts, if they're going to invest in those, is that the one of the risks is illiquidity. The money's tied up. They have to wait until the end, until there's a liquidity event. So the management company deploys the money, buys a bunch of buildings, does things to fix them up and to make them earn more so that when they sell them, they'll be able to sell them for a higher amount of money. And it may take 3, 4, 5 years before they're able to do that. And in the meantime, the customer can't get their money out if they change their mind and want to go do something different. They got to hang in there.
Okay. So you just really, like any other investment, you really want to look at everything, make sure it's going to be a good investment for you. Obviously, to consult with an expert that understands how they work and can really lay out everything for you. So thank you so much for coming in and sharing about REITs with my listeners.
Sure, you bet.
Look forward to having you back, Gary.
Thank you very much, Tina. And
this is your host and mortgage expert, Tina Mitchell, signing off for the day. Thanks for listening to the show today. I'll be here same time, same place, right here at 1150 AM KKNW next weekend.